Welcome back to Learn SKN, and today we're going to continue looking at some econ content, some CSEC economics. So last time we looked at objectives 8, 9 in the syllabus, and so today we're going to be looking at part of section of objective 10, which is to do with inflation. But before we reach inflation, we're going to be looking at some government policies that are crafted to deal with inflation and recession. So the first part, we're going to look at the policies that are used to, combat inflation and recession, and then in a subsequent video, we're going to be looking at inflation directly. All right, so you know what to do. Like the video, subscribe to the channel, hit the bell, so you know when Learn SKN drops another video. All right, so let's just jump right into the content for today. And so the government, they have certain policies, certain macroeconomic goals that they are trying to achieve. They include things like price stability, reduce unemployment, ensure that there's economic growth, and make sure that the balance of payments are favorable for the country. And so these are things that we're going to look at, because when you look at price stability, that is where inflation comes into play. And when we're looking at economic growth and balance of payments and those things, that's where the recession comes into play, because the recession can reap havoc on all of those macroeconomic goals. So macroeconomics is a study of the economy as a whole rather than the individual markets and other elements of which it consists. These are the four goals or objectives of a government macroeconomic policy. We will examine the nature of recession in chapter 18, and we will look at international trade and balance of payments later on. So let's go. First things first. Monetary policy. What is monetary policy? Monetary policy is the use of interest rates and other direct measures to control the money supply and consequently aggregate demand in the economy. So let's get this word out of the way first. Aggregate demand. What aggregate demand means is demand that has, remember we're looking at the economy as a whole. So we're combining all the demand in the economy. So everybody would have an individual demand curve, or a market would have their own demand curve. But when you combine all of them in a country, we have what we call the aggregate demand. And so the aggregate demand is talking about the demand on the national level, on a macroeconomic level. So it's the same concept as demand, but we just want to differentiate between regular demand, which is individual demand curve, business demand curve, with the demand curve that matches the entire economy, right? And so that's what we have there. Aggregate demand and aggregate supply is where you have supply being tallied for every single producer and demand for every single individual and firms on a macroeconomic level. So policies used by the government to achieve macroeconomic goal. The first one we have here is what we call fiscal policy. I don't know how many of y'all listen to business news, listen to government people talking, even listen to the politicians out there talking about fiscal imprudence or fiscal responsibility, that kind of thing. Fiscal policy is about how the government spend the money and how they tax the people. That's fiscal policy. It's the manipulation of government spending and taxation to achieve certain broad economic objectives. That's the definition for fiscal policy. So if you want to write it, it's not in the book. If you want to write it, fiscal policy is the manipulation of government spending and taxation to achieve certain broad economic objectives. That is fiscal policy. The manipulation of the government spending and taxation to achieve certain broad economic objectives. So it can either be to increase demand in the country, or reduce demand in the country. Increase supply, reduce supply, whichever one. So whatever economic objective they are trying to achieve, the government can use fiscal policy to achieve that outcome. And so that's one of the backbones of monetarist economics. You have fiscal policy, monetary policy, and we are going to look at them individually. So again, fiscal policy is the manipulation of government spending and taxation to achieve certain broad economic objectives. The term, if you're following here, the term aggregate is a term used in macroeconomics that means total. So aggregate demand is the total demand in the economy. When the government increases government spending and or reduces taxes, this increases aggregate demand in the economy. And thus the term expansionary or reflationary fiscal policy. So expansionary or reflationary fiscal policy. When the government decreases government spending and or taxation, this decreases aggregate demand and is termed contractionary or deflationary fiscal policy. So let's clear up that right now. So what is fiscal policy? In a nutshell, fiscal policy is the manipulation of government spending and taxation to achieve certain broad economic objectives. You can use the textbook's definition also, which is fiscal policy is the use of government spending and taxation to control aggregate demand in the economy. So let's think about it logically now. So these two words popping out right here: expansionary and contractionary. Expansionary, contractionary, same thing as reflationary. Contractionary, same as deflationary fiscal policy. So what we're saying here, right, is that let's say the country is in a position where demand is very low. Demand is very low for goods and services. And so if demand is low for goods and services, this can lead to an economic downturn. This can lead to a recession. That's not a good thing for an economy. So if demand is low, then the government can use fiscal policy to try to increase demand. How can they do this? Now they can use either government spending or taxation to increase aggregate demand. How can they do this? Let's say you want to increase demand. And remember, the law of demand states that when something price go down, people demand more. And so a good example will be coming up shortly, where the government would have a VAT reduction there. So that's fiscal policy right there, because they want to try to stimulate the economy. So you know, in December you have 2 VAT days, VAT reduction days, and the main aim of these VAT reduction days is to try to stimulate the economy, to increase demand, aggregate demand. So it's a good thing we could recognize it right now, because you know, on reduced VAT day, everybody gone out the shop. That would pump money into the economy. That would increase the demand, because the price of things gone down now because of the fiscal policy. By reducing taxation, by reducing the tax, the VAT, they create cheaper goods, and the law of demand states that when goods are cheaper, you tend to buy more. And so that's how the government can use taxation to increase its the overall demand in the economy, the aggregate demand. They can use taxation to reduce the cost of living, reduce the cost of items, and that would in turn encourage persons to buy. So that would increase demand. And of course, you know, the reverse is true. If they want to reduce demand, because maybe too much people demanding everything, and that can lead to inflation. And so we don't really want any inflation either, because if too many people are demanding little bit of stuff, it leads to inflation, meaning the price will be driven up. Government don't want inflation in the economy. So what would they do is increase the tax on certain things. And if it increase the tax on certain things, make them more expensive, then that means that the demand for these goods will fall. Lot of demand coming into play again. The demand for the goods will fall, and so the economy will be able to settle down and reduce some of the inflation. So that's how the government can use taxation as part of the fiscal policy to manipulate the aggregate demand. Now, the other part of fiscal policy is government spending. So let me explain how government spending can lead to an increase in demand in the economy or a reduction in demand in the economy based on what outcome the government wants. Now, if the government increase spending, this can lead to an increase in demand. For example, the government can say, okay, things kind of slow right now, the economy not doing as well. Let's build a road. Let's build some schools. Let's build some houses. Let's start a roof program. Right? These kind of initiatives would create jobs, and they would put money in persons' pockets, and then those persons will in turn trickle down in the economy. They would go to the shop to buy something, go to the supermarket to buy something, so that would increase demand. Because the government increased their spending, and so when they increase their spending by doing things like roads and infrastructure projects and those kind of things, that can lead to an increase in demand. And that can cause the economy to boom again. And of course, the reverse is true. If the government wants to slow down the demand, they can reduce government spending, so pull back some of the money out of the economy, take back some of the jobs in essence, don't start any projects, and so that would cause the demand to fall because not as much money going around in the economy. Right? So that's how they can use fiscal policy. Expansionary fiscal policy is when they want to increase demand. Contractionary fiscal policy is when they want to decrease demand. So expansion, they mean you're expanding the economy, so you want to grow, so you increase demand. And contractionary is when you want to pull back demand, decrease demand, and so that's called contraction. It's when you become smaller. Another name for expansionary is reflationary. Another name for contractionary is deflationary fiscal policy. So that's fiscal policy in a nutshell. So it is the government's way of controlling the economy using spending and taxation. And they can choose to either expand the economy with expansionary fiscal policy or pull back, contract the economy with contractionary fiscal policy. So remember, fiscal policy has two parts. It can either be through taxation or through government spending. Taxation would be very easy to understand because if they increase tax, that will decrease demand. If they reduce tax, that will increase demand in the economy. So you can see how taxation can be used to manipulate the economy to get demand up or down. Same way with government spending. If you want to put money in the economy, boost up the demand, you start spending more money on projects and different things and infrastructure. Just spending money on things that would employ persons. And these persons would get a salary, they would buy things in the supermarket, so demand starts purring, start increasing. Right? So that is fiscal policy as one of the policies government can use to manage the economy. Fiscal policy. I know some people might say physical, but it's fiscal policy. Then we have monetary policy now. I would have touched on monetary policy before when we were looking at banks and central banks and those kind of things. So what is monetary policy? As the name suggests, monetary, money. So it's the manipulation of the money supply using interest rates to try and control, so try to achieve certain broad economic objectives. So it's the manipulation of the money supply using, the manipulation of the interest rates to try to influence the money supply to achieve certain broad economic objectives. So that's monetary policy. is the use of interest rates and other direct measures to control the money supply and consequently aggregate demand in the economy. Other instruments of monetary policy are open market operations and adjustments of required reserve ratio, all of which we have touched already. So remember, we look at those when we're looking at the central bank controlling the money supply. So we don't have to rehash that one. So monetary policy is the use of interest rates to and other measures to achieve certain broad economic objectives, such as manipulating the money supply. So you're manipulating the money supply. So the main aim of monetary policy is to manipulate the money supply using interest rates, open market operations, and all those things that we discussed before, repo rates, reserve requirement ratio. They can use all these tools to try to impact the money supply. If the money supply is too high, that can lead to inflation. If the money supply is low, that can lead to recession. And so the same two words apply again: expansionary or contractionary monetary policy. You can either expand the economy with monetary policy or contract the economy with monetary policy. Same way with fiscal policy. So those are the two main policies you'll hear about from government. Those are the two main ones: monetary policy and fiscal policy. Monetary policy deals with manipulating the money supply to achieve certain broad economic objectives, and what they are using is the interest rate, open market operation, reserve requirements, and those things. So anything to do with government money, government spending, and taxation, that is fiscal policy. Anything to do with the money supply, so the central bank and those things, money supply, that's monetary policy. So the government, in most economies, they have certain economic goals they're trying to achieve, certain macroeconomic goals. Like, for example, they don't want any inflation in the economy. They want a stable price. They want economic growth and those kind of things. So we look at these up here. There are 4 of them up here. So they want a stable price, low unemployment, economic growth, and a favorable balance of payment. And to achieve these goals, they have 2 main policies at their disposal, the government. 2 main policies. One is called fiscal policy, and one is called monetary policy. Fiscal policy is the manipulation of government spending and taxation to achieve certain economic objectives, whether it is to increase demand or decrease demand. But it's about government spending and taxation. When the government spends money, they pump money in the economy, and so that can lead to an increase in demand for the overall economy. That's a good thing, but not too good if you go way out of hand. So if you go way out of hand and they want to pull back on some of the demand, they would reduce spending, and so they wouldn't have as much money out there in the economy. So when you increase in demand, that's expansionary or reflationary fiscal policy. When you want to decrease demand in the economy, the government would use contractionary or deflationary fiscal policy. Monetary policy is the use of the interest rates to manipulate the money supply, and this can be used to try to increase or decrease aggregate demand. So manipulating the money supply, and so that's monetary policy. And so there are some tools that the government can use on the monetary policy. The tools of fiscal policy, that's government spending and taxation. For monetary policy, you have interest rates, and you can manipulate the interest rate and the money supply, right? The money supply, interest rates. And you can manipulate the money supply and the interest rates through using various tools. And we cover a lot of these tools in, it was POB we covered them in. So for those who are not doing POB, we'll go through these tools just now. Right? So that is the two different policies that the government has at its disposal to try to achieve certain economic objectives. Monetary policy have some instruments: interest rates, open market operations, and adjustments to the required reserve ratio. So the tools that the government has at its disposal in monetary policy would be interest rates, open market operations, and the reserve requirement. Monetary policy that increases the money supply and aggregate demand is termed expansionary, as we said before. So if you want to increase the money supply, increase the money supply and demand, that's expansionary. These includes reducing interest rates, improving the availability of credit, open market operations, reducing required reserve ratio. And so we went through all of them before, but we'll just jump to them again. So let's say that you're in an economy. You're in an economy and demand is super high. Right, so you have an economy and you want to try to increase demand. You had a recession, things kind of slow in the economy, and you want to increase demand. You can use monetary policy to try and do this. How? You can reduce the interest rates that banks charges for loans, so you make money easier to borrow, as I said before. So when you reduce the interest rate, that causes money to be cheaper, and so persons will be quicker to borrow money, and they're going to use that money to try to invest, to buy things, and so that would increase the money supply, and that would increase demand. When the interest rate reduces, that means they have to pay back less, and so everybody wants to go for a loan now, and so they go for the loan, and that loan will be used to help to boost the economy, stimulate aggregate demand, and at the same time increase the money supply. So that's one method of expansionary monetary policy. Increase the interest rate. Once the interest rate goes up, reduce the interest rate. Once the interest rate goes down, that means that borrowing money for firms and for individuals is cheaper, and so that would help them to go get more money to boost up the economy, and that would increase the money supply and increase demand in the economy. They might want to improve availability of credit to customers, and so this can be done via the banks. Right, it can decrease the amount of down payment you have to make, and that would cause the money again to be relatively cheap, and so you'll want to go for a loan for that for sure, because all of a sudden it requires less money as a down payment. So by decreasing the down payment needed and increasing repayment periods on loans, a lower down payment makes it easier for individuals to enter into higher purchase agreements. Having to make a down payment of only 10% on a car to obtain a loan from a bank is much easier than having to make 15% down payment. So once they make the credit cheaper, that could lead to increased demand. Then we have an next oldie but goodie, open market operations. Remember, we look at treasury bills and treasury bonds, and we said that if the government wants to increase the money supply and increase demand, they would go and buy. They would go and buy treasury bonds. They would go and buy treasury bonds. So that would put money into people's pockets and into the economy, and that can cause a bump in the aggregate demand. So this is the buying and selling of government securities. That's open market operations on the open market. When the government buys back securities from the holders, these securities, they pay them money in the hand, which increases the money supply as money enters the financial system. So it's very simple. Open market operations is where the government, using the central bank, is buying and selling treasury bonds, treasury bills. And so if they want to increase the money supply, they want to boost the demand, they can very well buy. So people might be holding these treasury bonds. The government can buy them from the people and give them back the money, and that would pump new money into the economy, and that would in turn cause an increase in aggregate demand in the economy. Then we have one here, the last one, as we said before, reducing the reserve requirement ratio. So remember we said that the commercial banks are controlled by the central bank. And one way they are controlled by the central bank is when the central bank insists on how much money each commercial bank should retain, should leave back, should hold back in reserve. And so if the amount that they have to keep back in reserve goes down, then that would mean that they have more money to lend, and so that can lead to an increase in the money supply and an increase in demand. So reducing the reserve requirement ratio, all banks are required by law to keep a certain percentage of their deposits as reserves. The lower the reserve requirement, the more banks can lend and the greater the money supply will be. So using the reserve requirement ratio, the central bank can tell banks, okay, we want the economy to boost up. So what we're going to do, we're going to lower the amount of money you have to keep back. So that now means that the banks have more money to lend, and some more loans going out to different people, and that would help to boost demand in the economy. So that's how reserve requirement ratio would be used to boost demand and increase the money supply. So those are examples of expansionary monetary policy. And so you know that the contractionary one would be the opposite, right? If you're trying to small up the economy, get it smaller, get demand down, then you'll do the reverse. Increase interest rates, make credit less accessible, and the open market, you're going to be selling treasury bonds and bills instead of buying them, is selling them. So that's taking money out the system, and the central bank can increase the reserve requirement ratio for the commercial banks, which cause them to have less money to lend. So yes, we're going to stay here for now for this video. So that's it for the policies that the government can use to manipulate the economy in any which way they desire. You have a monetary policy, you have a fiscal policy. They can be utilized to manipulate the economy, whether they want to increase demand, reduce demand, whichever one, fight inflation, fight the recession. They're going to know how to use these policies. So we're going to stay here for now, and then in the next video we're going to be looking at inflation and some of the consequences of inflation, etc. Alright, so you know what to do. Like the video, subscribe to the channel, hit the bell so you know when Learn SKN drops another video on economics for CSEC.